This LOS is compare the financial reporting of the following types of intangible assets: purchased, internally developed, and acquired in a business combination. So we'll start by going through some key terms with regards to intangible assets. An intangible asset is an identifiable, non-monetary asset without physical substance. An asset is a resource controlled by an entity as a result of past events and from which future economic benefits are expected to flow to the entity. Research, original and planned investigation undertaken with the prospect of gaining new scientific or technical knowledge and understanding. Development, the application of research findings or other knowledge to a plan or design for the production of new or substantially improved materials, devices, products, processes, systems, or services before the start of commercial production or use. Cost is the amount paid or fair value of other consideration given to acquire or construct an asset. And finally, useful life is the period over which an asset is expected to be utilized or the number of production units expected to be obtained from the use of the asset. Acquisition of long-lived assets. Intangible assets. Under IFRS, intangible assets must meet three definitional criteria. They must be 1, identifiable, either capable of being separated from the entity or arising from contractual or legal rights; 2, under the control of the company; and 3, expected to generate future economic benefits. In addition, 2 recognition criteria must be met. 1, it is probable that the expected future economic benefits of the asset will flow to the company, and 2, the cost of the asset can be reliably measured. Intangible assets purchased in situations other than business combinations. Intangible assets purchased in situations other than business combinations, such as buying a patent, are treated at acquisition the same as long-lived tangible assets. They are recorded at their fair value when acquired, which is assumed to be equivalent to the purchase price. If several intangible assets are acquired as part of a group, the purchase price is allocated to each asset on the basis of its fair value. Now we'll look at intangible assets which are developed internally. In contrast with the treatment of construction costs of tangible assets, the costs to internally develop intangible assets are generally expensed when incurred. There are some situations, however, in which the costs incurred to internally develop an intangible asset are capitalized. The general analytical issues related to the capitalizing versus expensing decision apply here, namely comparability across companies and the effect on an individual company's trend analysis. Continuing with intangible assets that are developed internally, IFRS require that expenditures on research or during the research phase of an internal project be expensed rather than capitalized as an intangible asset. Generally, US GAAP require that both research and development costs be expensed as incurred, but require capitalization of certain costs related to software development. Costs incurred to develop a software product for sale are expensed until the product's technological feasibility is established and are capitalized thereafter. Continuing with internally generated intangible assets, expenditure on research or the research phase of an internal project is to be written off as an expense as and when occurred, as it is not possible to demonstrate that an asset exists that will generate future economic benefits. Examples include activities aimed at obtaining new knowledge, the search for, evaluation, and selection of applications of research findings or knowledge, the search for alternatives for materials, devices, products, systems, or processes, and finally the formulation, design, evaluation, and selection of possible alternatives for new or improved materials, devices, products, systems, or processes. Development expenditure may be recognized as an intangible asset when and only when all of the following can be demonstrated. 1, the technical feasibility of completing the asset so that it will be available for use or sale. 2, the intention to complete the asset and use it or sell it. 3, the ability to use or sell the asset. 4, how the asset will generate probable future economic benefit, including demonstrating a market for the asset's output or for the asset itself or the asset's usefulness. 5, the availability of sufficient technical, financial, and other resources to complete the development and to use or sell the asset. And finally, 6, the ability to reliably measure the expenditure attributable to the asset during its development. Examples of activities that may fail to be recognized as intangible assets include the design, construction, and testing of pre-use prototypes or models, the design of tools and jigs involving new technology, the design, construction, and operation of a pilot plant that is not capable of commercial production, and finally, the design, construction, and testing of a chosen alternative for new or improved materials, devices, products, systems, or processes. So those are examples of activities that will not be recognized as intangible assets. So let's do a practice problem to check our understanding. A company which prepares its financial statements in accordance with IFRS is in the process of developing a more efficient production process for one of its primary products. The most appropriate accounting treatment for those costs incurred in the project is A, expense them as incurred, B, capitalize costs directly related to the development, or C, expense costs until technical feasibility has been established. Okay, that's a nice little practice question just based on some of the slides that we looked at. The correct answer is C. Under IFRS, research and development costs are expensed until certain criteria are met, including that technical feasibility has been established and the company intends to use it. Now a look at intangible assets acquired in a business combination. Under the acquisition method, the company identified as the acquirer allocates the purchase price to each asset acquired and each liability assumed on the basis of its fair value. If the purchase price exceeds the sum of the amounts that can be allocated to individual identifiable assets and liabilities, the excess is recorded as goodwill. Goodwill cannot be identified separately from the business as a whole. So we'll finish this LOS with a practice question. Assume US GAAP applies unless otherwise noted. During late December 2008, Company A acquires a small competitor, Company B. During the evaluation of the acquisition, it is determined that the customer lists of Company B have a fair value of $50,000. Company A has spent $15,000 during the year updating and maintaining its own customer lists. What will be the value of the customer list intangible asset on Company A's 31st December 2008 consolidated financial statements? A, $15,000, B, $50,000, or C, $65,000? Okay, the correct answer is B. The purchase customer list is an identifiable intangible because it can be sold separately from the company and it would be recorded at its fair market value. The amount paid for in the acquisition, $50,000. The amount spent by Company A on its own list, $15,000, would have to be expensed because internally generated intangibles are not capitalized. And that's the last slide for this LOS. Thank you.